Welcome to Mayer Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayer Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is Mortgage Market Update Part 2, Mortgage Securitization and MSR Updates, which is the second installment of a three-part podcast series on the mortgage market. My name is Haukur Gudmundsson. I'm a partner in Mayer Brown's banking and finance practice in our Chicago office. Joining me today are Mayer Brown partners Miller Smith, Eric Edwardson, and Krista Cooley. Miller Smith is a partner in our banking and finance practice in Charlotte. Eric Edwardson and Krista Cooley are both partners in our Washington, D.C. office in our financial services, regulatory, and enforcement practice. With that said, let's begin. At the beginning of the year, we had several discussions about the state of the mortgage market as part of our annual series called What to Expect in 2023. Since then, many things have stayed the same and many things have changed. So we wanted to bring you a brief update. In the next 30 minutes or so, we're going to talk a little bit about the current state of the RMBS and CMBS securitization markets in particular, and the mortgage market in general. We'll also talk a little bit about Ginnie issuances and some changes to the Ginnie program that help or might help Ginnie issuers ameliorate certain economic pressures that they face. Finally, we'll tell you about some updates relating to MSRs. First, with the RMBS market. When we spoke at the beginning of the year, we compared RMBS securitization volumes in 2022 with issuances in 2021, and decreases across almost every subcategory were pretty significant. There's little new to report there, I suppose. The downward trend in private label RMBS seems to be continuing. For example, a recent report suggests that private label RMBS issuances are down 14% from first to second quarter of 2023, and prime jumbo issuances were down 21% quarter over quarter. However, there is some encouraging news. The same sources report a 36% increase in volume of agency RMBS issuances in the second quarter compared to the first. Interestingly, that increase seems to consist of a 40% jump in purchase money mortgage loans and a 28% increase in refinance activity. One would expect that this apparent uptick in production will eventually spill into the private label market, which would be consistent with our experience as the pipeline of deals heading to the market seems to be picking up a bit in recent weeks. Another recent development is that many sellers have reported significant increases in agency repurchase demand, and as a result, relatively increased volumes in scratch and dent loans, and we've started to see some rated securitizations with heavy concentration of scratch and dent loans. Whether that trend continues remains to be seen, though. Other things remain the same. I'll just mention here that we continue to see robust activity in the SFR space, a lot of HELOC activity, home equity option contracts and other home equity products that become more attractive to consumers relative to cash out refinancings in a high interest environment. And as Eric will talk about in a bit, MSRs continue to be active. One trend on the MSR front that I'll mention here is that we've seen a lot of activity with these GSE excess yield securitization, pursuant to which the servicer sells excess yield back to the GSE in exchange for pass-through bonds backed by that excess. Although those transactions have occurred in the past, they've largely been dormant during the recent low interest period. For the last 18 months or so, in a flurry of these, as servicers take advantage of historically high MSR values. I now turn it over to Miller Smith to tell you about the latest in CMBS. Miller.
Thanks, Haukur. I'm Miller Smith, and I'm going to start off today speaking about CMBS issuance volume for the first half of 2023. As Haukur mentioned for RMBS, we gave a recap of 2022 CMBS issuance at the beginning of the year in our What to Expect podcast, and we thought it might be helpful just to provide some updates now that we're a little over halfway through the year. The Commercial Mortgage Alert has reported that despite a 35% increase in issuance in the second quarter of this year, with $23.6 billion in the second quarter, up from $17.44 billion in the first quarter, the annual volume of commercial mortgage securitizations is on track to hit a 12-year low. And the issuance volume of $41.04 billion for U.S. CMBS, CRE, CLO, and agency issuers during the first half of 2023 is a 68.3% decrease from the first 6 months of 2022, when issuance volume in the same sectors was over $129 billion. Of that, roughly $41 billion issued in the first 6 months of this year, almost $16.5 billion were U.S. CMBS deals, $22.4 billion were agency deals, and $2.11 billion were CRE CLOs. This is down from almost $50 billion in U.S. CMBS, $55.4 billion in agency, and $23.97 billion in CRE CLOs in the first half of 2022. And of the U.S. CMBS issued in the first and second quarters of this year, roughly $9.4 billion were conduit deals, and a little over $7 billion were single asset, single borrower deals, down about 44% and 78% respectively from the first half of 2022 for conduit and SASB. So market participants seem to be divided on whether issuance will increase at all during the third and fourth quarters of this year. And a recent Commercial Mortgage Alert survey indicates that participants are also divided on where CMBS spreads will end up in the second half. But some originators are still papering new deals. The biggest issue really just remains interest rates and whether securitization exits are viable given bond spreads and what borrowers are willing to accept on the underlying loans. However, despite this continuing market volatility due to uncertainty about interest rates, the fallout from the regional bank crisis, and other factors, there still are some new issuance deals in the pipeline. There's at least 2 single borrower deals and a CRE CLO coming to market at or around the time of this recording. We also mentioned 5-year conduit deals in our February podcast. We've seen several of these deals over the course of the year so far, but we've also seen Freddie Mac doing 5-year deals, and Freddie has indicated that it expects to issue another 2 to 3 5-year deals before the end of this year. This is not a new product for Freddie, but due to the increased demand from borrowers for shorter term loans and combined with reduced pricing from historical levels on both the Fannie and Freddie side for this product, the supply is such that deals collateralized solely by these 5-year loans are an option. And investors have indicated that these deals are less risky and produce a higher yield than the 10-year bond, so the investor demand is there. Office properties remain a major source of concern in the commercial mortgage sector, and as delinquencies and special servicing rates increase, we're seeing more and more activity in the distressed debt space, including modifications, workouts, foreclosures, and deeds in lieu. The TREP CMBS special servicing rate increased by 31 basis points in June of this year, which was the 5th increase in a row and the 3rd largest increase this year. Of the underlying property types, the increase in the office sector was 81 basis points over the May level. All that being said, these issues do present opportunities for capitalized funds or investors that are able to take advantage of the decreased property values. Although the delta between what a potential purchaser is willing to pay versus the price a distressed borrower is willing to accept for a property continues to remain large, perhaps driven at least in part by limited pressure on borrowers resulting from lenders agreeing to extensions and other modifications. This may change as time goes on, though, if lenders elect not to continue to grant extensions and mods. As can be expected, decreased property values are affecting borrowers in a very material way. The borrowers are having to come up with more and more equity than ever before to close loans that are also more expensive to debt service because of the historically high interest rates. So this also results in more loans with related debt such as mezzanine debt, preferred equity, or B notes. Additionally, the costs for rate caps on floating rate loans, although it's become a bit less expensive in the past few months, it still remains very high compared to historical levels. On the regulatory front, there was a lot of focus at the beginning of the year on the SEC's proposed conflict of interest rule, which was widely viewed by securitization advocates as potentially creating major issues for securitization markets. The comment period for that rule ended at the end of March, but following the intense feedback, it's been reported that the release has been delayed, and the SEC is now aiming to finalize that rule in the spring. And as we discussed in our first podcast in this mortgage market update series regarding bank capital requirements and related developments, banks continue to focus on regulatory capital requirements and the impending release of the significant expected revisions to the U.S. regulatory capital rules. That's also something that we're watching closely. And now I'll turn it over to Eric Edwardson for an update on the current residential mortgage markets.
Thanks, Miller. I'm going to speak a little bit here. We're turning back to the residential mortgage markets. I'm going to speak a bit here about the economy. As I'm listening to Miller, realizing that a decent amount of this applies equally to commercial mortgage, but not all of it. So it fits well in the middle. Let me start off by saying, despite having majored in economics as an undergraduate a long time ago, I'm no economist. I'm really just reporting what other folks are saying there and what people know about the general trends, but looking at it towards how it affects the residential mortgage environment. First of all, general economy, everybody's seen the reports, recent reports of inflation easing. It's certainly not tamed. I believe the Fed is targeting to get it down to 2%. It's at 3 and change, I think was the last report. There are still thoughts about a recession. I saw there was a couple of articles that ran around recently talking about a vibe session where everybody's been talking about a recession coming, and yet it doesn't seem to have come around the corner yet. But there is perhaps a little easing or a little bit more comfort that maybe we'll dodge that. Goldman Sachs recently in a prediction reduced its odds of a recession in the next 12 months from 25 to 20%. To begin with, that's a lower percentage than a lot of other people are repeating, and that's a pretty marginal change, but at least some degree of optimism. The Mortgage Bankers Association is projecting reduced growth of the economy overall and increased unemployment, at least over the next 12 months. And of course, we have the factor of the bank failures that we went through. Hopefully those are done and we won't have to deal with that anymore in the next 6 months. Tying that into the residential mortgage market, we've got the higher interest rates. I mean, that's not new that we've got higher interest rates, but it's worth talking about some of the details of the current situation. The Fed just recently hit pause on its rate increases, but it is expected to go a little bit higher to be sure it's on top of inflation, as I just mentioned. At a minimum, they're going to be keeping them at these levels for the rest of the year, so we can anticipate general market rates staying up at that level. Mortgage rates, they're still obviously well above recent historical averages, but there may be some light at the end of the tunnel. The Mortgage Bankers Association June 20th projections identify this past quarter, the quarter 2 of 2023, as a high point in rates, with some reduction in rates from here on out. Query whether they're being optimistic as the Mortgage Bankers Association, but at least they're not being pessimistic. And the housing prices in the market are arguably rebounding from being recently flat to declining in some markets. That's not totally clear. The MBA's recent report also shows some decreases, but I've seen other reports showing increases, at least in some significant markets. Obviously, the higher interest rates are part of what's pushing down demand. Folks who reduces the house affordability for folks when they're going to have to take out a higher interest rate loan. But there's also decreased supply. There's decreased housing starts, which may be a product of a bit of a boom over recent months and some concern of theirs on the general economy. There's also a big factor of rate lock-in. Folks who have loans or living in a home who maybe would be looking to downsize or upsize for that matter to a new home, who are there at a 4% interest rate, obviously, and not very incentivized to give that up in the course of selling and buying a new home. So they're reluctant to sell. All in all, the market for sales is really a bit frozen. Redfin just reported that only 1.4% of homes changed hands so far this year in 2023. That's down nearly 30% from a similar portion of 2019, and that change is even more severe in suburban and rural housing as opposed to urban housing, and in high dollar markets like Northern California. So turning to the effects of that on the actual primary business of originating and servicing mortgage loans, residential mortgage loans in particular. Originations still, both purchase and refinance, are down, although maybe a little better than they were 6 months ago. There's continued stress on the originators, but I think those who have made it this far have taken certain steps of reducing staffing or things to cut their cost, and so we're probably in a healthier environment for those originators than we were 6 months ago. There's a perceived somewhat increased risk of delinquency, bankruptcy, and foreclosure. So that would affect the servicers. That is, as shown in the MBA's projections of higher unemployment and general economy malaise, at least for the next 12 months. Query, maybe part of that could be from an expanded credit box. Certainly as origination volumes have dried up, people may be stretching. There were quite a lot of overlays to other requirements during the boom days when you could afford to sort of turn down folks with certainly acceptable credit, but maybe not quite as good as it had to be. Anecdotally, I've heard of some preparation at some servicers for a shift to greater delinquencies with them moving staff to those areas of like bankruptcy and foreclosure, but it also could be equally true that they're looking to just keep people with something to do while they wait for things to pick back up. All these factors will lead to an increased need or continuation of the currently increased need for liquidity, for lending, for P&I, principal and interest, and servicing advances and other costs of the servicers. The kicker to all this, of course, is that liquidity also costs more because of the interest rate increase. Against that backdrop, I'm going to turn this over to Krista Cooley, and then she'll turn over to Haukur Gudmundsson, who will talk some more about some particular topics.
Thanks, Eric. So I'm going to spend the next few minutes covering some updates in the Ginnie Mae space and the FHA space that have been announced in recent months and are really designed to address some of the liquidity challenges that holders and servicers of both forward and reverse agency loans have been facing, and really expressly based on the agency's comments on these developments are designed to create some market stability in this unique and volatile market that my colleagues have just described. So the first one of these developments is that earlier this year, Ginnie Mae implemented changes that it had announced last fall regarding seasoning requirements for what it calls reperforming loans, to allow those reperforming loans to be repooled into Ginnie Mae securities more quickly. So back in 2020, when we were in the thick of the pandemic and loans that are issued into Ginnie Mae securities were going into CARES Act forbearances, which were an incredibly extended forbearance period than the market had seen before. They qualified for early buyout from Ginnie Mae pools at a much faster and higher rate than we historically had seen. And some of those cured through modifications, but many of those cured through just reperformance of the borrower in the forbearance period, or through another loss mitigation option like a partial claim, which doesn't require the change of the rate or the term of the loan through a modification. And so what Ginnie Mae did back then to just try to create some stability was that they announced that loans that were bought out of pools and that reperformed without changes in the loan rate or terms. So, for example, those that were cured by partial claims or that reinstatement without modification had to meet certain seasoning requirements before they could be repooled. And upon repooling, were only eligible to be repooled into very specific pools that were created for loans that met these criteria. These seasoning requirements were always designed to be temporary, but they, when implemented, required that before the loan was eligible for repooling, the borrower needed to have made timely payments for at least 6 months, and the MBS issue date had to be at least 210 days from the last delinquency date. So that created a circumstance in which servicers had to hold these early buyout loans on their books for a longer period of time before they could repool and reduce that capital requirement. The new requirements that were announced and were implemented for pools submitted on or after February 1st of this year have reduced those seasoning requirements to 3 months of timely payments and 120 days from delinquency date to MBS issuance. So really cut those seasoning requirements in half. Another positive development is that reperforming loans that meet these new seasoning requirements can be repooled into the Ginnie Mae multiple issuer single family pools and not just those custom pools that were announced back in 2020. So this shorter holding period and expanded pool eligibility is really designed to reduce the capital, either working capital or EBO financing that servicers were using to buy out and hold these EBO loans. HUD and Ginnie Mae also released guidance recently designed to ease liquidity constraints. And these are focused on issuers and servicers of the HECM, which is HUD FHA insured reverse loan product. First, in February, Ginnie Mae announced a reduction in the minimum pool size for HECM MBS. So effective April 1st, the required minimum pool size was reduced from $1 million to $250,000. And this was in an effort to minimize the amount of time that issuers need to carry balances between disbursement to HECM borrowers and the HMBS securitization process. Second, in May, HUD issued a new mortgagee letter, it's 2023-10. And in that mortgagee letter, it announced changes to its HECM assignment process, which is designed to expedite the processing and payment times for claims that go through an assignment to FHA. And that, again, is also designed to improve servicer liquidity and create some market stability. So there's a couple of different ways that HUD will pay a HECM claim. One of them is that when the loan becomes close to, when it reaches 98% of the maximum claim that HUD will pay, if the loan is current and meets other eligibility criteria, HUD will actually take assignment of the loan, pay the servicer the claim to take it off its books, and continue to service the loan through maturity. What HUD did with this mortgagee letter is change the criteria for that assignment process. So it lowered the minimum balance. So you can submit an assignment claim when the loan hits 97% instead of waiting to 97.5%. And they also now permit servicers to submit copies of the original note and mortgage with that initial claim request, and then follow up with the original documents within 90 days of the claim payment date. And that really just frees up the amount of time and delay that was caused by the servicer having to go pull the original note and mortgage and secure that before they could file the claim and get paid. They also gave HECM servicers a 12-month period to submit the recorded assignment. Prior rules only provided 6 months for HECM loans that were originated before a certain date. So this gave servicers a longer time to get through that process after the claim is paid. And they also reduced the documentation that servicers need to provide to obtain preliminary title approval, which is a necessary step for HUD to approve the assignment claim. And again, all of these were designed to streamline the process and get claim funds paid more expeditiously to increase liquidity for HECM servicers. And the last one I'll mention is another mortgagee letter that just issued earlier this month. It's 2023-15, in which HUD announced modifications to its process for determining when a HECM holder or servicer may default on its obligation. So HECM loans, as I said, are the reverse loan product, and instead of collecting payments from the borrower, the servicer is actually obligated to make payments to the borrower. So when a servicer becomes challenged in its liquidity and able to make those payments, HUD has a second mortgage in place that it can step in and actually is required to step in and start making those payments. So what this mortgagee letter did was increase the information that HUD can use in order to make the determination that a borrower is about ready to default or a servicer has defaulted or will default. And it also requires those servicers to provide additional information to HUD so that they can provide the payments to the borrowers more efficiently. It's not directly beneficial to HUD servicers like the assignment claim changes are, but the stated goal with these changes was for HUD to create some sustainability in the HECM program so that it can ensure that that HECM loan is still a marketable loan that will continue to be securitized and create liquidity in this much smaller market than the forward loan market. They wanted to make sure that those who are securitizing have confidence that HUD will step in and quickly make payments to borrowers on defaulting mortgages to sustain that product type. There are a couple of other proposals that continue to be considered to assist issuers and servicers on how to manage the complexities of things like funding early buyouts and servicing advances and other gaps in timing between liquidity events and recoupment of funds through either repooling the sale of the loan or the insurance or guarantee claim payment, all of which are in the works. And I think we'll see continued developments in the space. And I know at this point, Haukur wants to discuss some of those developments, and so I will turn it over to him.
Yeah, thanks, Krista. I mean, I think it's safe to say that Ginnie issuers would love to see kind of further improvements on the program. I think one thing that I'll mention on the HECM side is I understand that Ginnie is kind of testing what's called ASAP HMBS, which would enable HECM issuers to pool loan participation, so-called tails, multiple times a month, which would allow, again, shorten the time frame that servicers are out of pocket for those for the related payments. The other thing that I think many issuers would like to see improved would be financing of servicing advances, like Krista mentioned. Ginnie has only allowed financing of advances within the last few years, and then only as a component of an MSR facility. On the other hand, both Fannie and Freddie will permit advanced financing in separate servicing advance facilities. In part, this difference is driven by different reimbursement mechanics between Ginnie and the GSEs. The GSEs will reimburse the servicer for advances irrespective of the performance of the MSR, whereas Ginnie servicers are reimbursed out of insurance proceeds. So there are some kind of programmatic restrictions on what enhancements are possible on the Ginnie side. Similarly, on the reverse side, tail financing can be challenging as tails are very closely tied to the related reverse MSR. But whether we see further accommodation from Ginnie to address these and similar concerns remains to be seen. And now Eric will give us an update on the state of the MSR market. Eric, over to you.
Thanks, Haukur. As Haukur said, I'm going to talk a little bit about the market for residential mortgage servicing rights, the buying and selling of those servicing rights. I'm focusing here on agency servicing rights, in other words, Fannie Mae, Freddie Mac, and Ginnie Mae, although principles would similarly apply into the private market. After a banner 2022 for servicing sales, they're down this year for sure, although we are seeing some signs of thawing in that market. To some extent, that's surprising. 6 months ago, we were talking about the factors that would lead to more sales of servicing rights, such as I mentioned before, the distressed originators who had been to that point accumulating portfolios of servicing rights and needed to sell some of those to keep the lights on, and the higher value of those servicing rights, since most of those were related to loans with 4% or lower interest coupons. The increase in interest rates, of course, increase the expected life of those MSRs because they wouldn't be refinanced, and therefore increase their value. Despite those those principles that would we look to push forward more sales, there's some other things going on that may be tamping this down. It's possible that a lot of those MSRs, that banner year of 2022, really pushed those out, and so now if they're left with new originations, they're down, so the MSR volume is down. These, as I mentioned before, if some of these originators really did what they needed to do to come through this stage, they may not have the need to push out those MSRs anymore, or maybe did so already. There's also recently in this first half of the year, there's been a couple of transactions, particularly a sale of Rushmore and Home Point, of whole companies, where there were movements of MSRs, both as a part of those, meaning to the buyers of those companies, or to others. And I think that to some extent that might lead to a sort of a sense of an undercount of how much MSR sale activity is going on, because there's a lot that is part and parcel of other M&A transactions, and those are just the ones that are well reported. There may be others out there that are similar. One thing is for sure, the prices for the servicing rights on bulk portfolios are down. The most recent, particularly for the most recent loans with higher interest rates, since those are particularly vulnerable to refinance relative to the lower interest rate. As long as we're flat, that's probably not a big risk. But if everybody's looking forward to a year from now having interest rates that start to come backwards, then the stuff that you're originating now, those servicing rights are more vulnerable, less valuable. The other factor out there is that there's other investment options for folks on the table that may have a more attractive yield. Consider the fact that a servicing right is yielding its servicing fee, typically 25 basis points relative to the principal value of the loans. Now, that's not the return because you're not paying for the whole principal value of the loans, but it's a fixed coupon, and just like any other fixed coupon of return, as the interest rates shift around, the value of that investment is going to change, and so the price could be understandably pushed down and maybe leading people sitting on the sidelines. There's, of course, also the feared downturn and potentially increased costs of servicing that go on there, which take your fixed coupon and eat into it if you have to spend a lot more money chasing people down and making P&I and servicing advances. All that said, think about thawing. We have seen here in the past month or so an uptick in seller interest in flow servicing sale arrangements. And these are, for those who don't know, the sale of servicing rights to buyers of the servicing rights at the same time as new originations are delivered to the agencies. I think that probably reflects, folks needing to get an ongoing business, maybe a little bit more focused on their originations, less interested in accumulating a book of servicing rights that they might have to leverage at a higher interest rate. Refinance recapture is the other topic I want to talk about, just to call it out there. And this might seem a little funny because, classically for the past few years, the talk about refinance recapture, and this is the exercise of an owner of servicing rights trying to stem the tide of people refinancing those and evaporating those servicing rights from underneath them by basically originating the replacement loans themselves. In other words, I've got an MSR, that loan, if that loan's got a 5% interest rate, let's say, if somebody comes along and refinances it from a completely different company, my MSR goes poof into smoke. But if you can do the refinance yourself, or do the refinance from somebody through the efforts of somebody else, then you can preserve the asset. It might be a new loan, a new servicing rights, but effectively you're preserving your set of assets. There's obviously a drop off on that classic type of refinance recapture, but we still see people coming in with ideas of coming in and preserving their assets there from other types of refinance risk, and most notably is the risk of refinance runoff as people try to tap into this increased equity from the past few years. So now, instead of talking the last 6 months, we're talking about the last 3 years. Somebody who got a loan at that wonderful lower interest rate may also have 50% more equity in their house, and how can they get into that? One way to do that is through a home equity line of credit. Strictly speaking, not a recapture exercise, is really a preservation of your servicing rights by virtue of the fact that if you can get somebody a home equity line of credit, then they're less likely to need to refinance their first lien loan in order to pull cash out. The trick is, this is, originating HELOCs and servicing HELOCs is significantly more complicated than a first lien loan. Or at least the servicing is, because you're having to make ongoing payments. There are a lot of sub-servicers who don't really do that, so your market for sub-servicers is narrowed down because sub-servicers are not in the business of funding the amounts that people want to draw on these home equity lines of credit. You've got to also, even if you do that successfully, you now have to service and track an additional asset. So it's no longer one big loan that you can handle at one time. And you've got to provide that ongoing financing, and then also deal with those in payoffs. If you split where those loans are, it can get more complicated when you're dealing with payoffs. The other option is a cash out refinance. Now, we're talking about something more like a traditional refinance, as we've been dealing with it for the past few years, where somebody gets a new loan that replaces it. In fact, by cash out refinance, by definition, it's a bigger loan, so has maybe additional value to it. The catch is that folks who are doing that are more likely to be going into a higher rate, whereas before you could tell the story of somebody who is, I'm going from a 4% loan to a 3.5% loan or something of the same value. The borrower's benefit is clearly there. If you're doing a cash out refinance at a higher interest rate and a larger balance, that's a more difficult balancing of risk and benefit. So for one thing, you may not get as many people to take you up on it, but it's also something to think about if you're going down that path, to think about levels of compliance risk that you could certainly see somebody come back and second guessing those loans, years down the road, that, I went from a 4% to a 5% and an extra extra $100,000 in financing. Could somebody come along and complain about that later on? At least at the margins, it's more likely, I think. The other potential recapture option, and I may be speculating a bit here, is like a reverse mortgage loan, right? There's a borrower can use that to refinance a loan as long as the balance is small enough to be captured in there. Indeed, there's even things such out there as purchase money reverse mortgage loans. But that would be an opportunity for folks who are on that retirement stage of life to tap into their equity without having to refinance their entire loan and grab all that money out in either a cash out refinance or a HELOC. Again, this is another one where it's not really a straight recapture like the HELOC. It's you end up with a completely different type of asset, and it may not be attractive to everybody. But I do wonder, having seen some reports of increased reverse volume, whether there's some degree of that happening just in the marketplace generally. And that's all I have, and I think I will turn it back to Haukur one more time for closing remarks.
Thank you, Eric, and thank you to each of my fellow speakers today, and thank you to our audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayerbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayer Brown audio programming, visit mayerbrown.com/podcasts. Thanks for listening.